Okay. Good afternoon to everyone in the room and those listening wherever you are online. My name is Hazel Bateman. I'm chair of this session and I'm a professor in the School of Risk and Actuarial Studies at UNSW. So this session is funding retirement with public reverse mortgages, an evaluation of Australia's home equity access scheme. And our speaker this afternoon is Dr. Katja Unrivalled, so my colleague and co-author. And Katja is a senior lecturer in the School of Risk and Actuarial Studies at UNSW, also coordinator of the Actuarial Co-op program. She's also the Business School's Dean's Research Fellow, and she's Director of Research in the Ageing Asia Research Hub at CPAR. I'd like to invite Katja to come and speak, and Katja will speak for about 30 minutes, and please put any questions or comments in Slido, and I'll deal with those after the presentation. So thank you. Thank you, Katja.
Thank you for the kind introduction. Welcome to the session on the Australian Home Equity Access Scheme, which has received a bit of attention last year with all the changes that the government has done to the scheme. And so we decided to follow that up and analyze whether the scheme is actually useful to Australian households. So we have done a lot of research on reverse mortgages. I came to Australia in 2011 to work with Michael Sherris on reverse mortgage product design, pricing. We published several papers in top actuarial journals understanding the risks underlying in commercial reverse mortgages. Now, in recent years, I've started to shift my research to work with Professor Bateman on understanding the demand side for these products, because theory tells us they are good products and they could help retirees achieve better outcomes. So a lot of our current research looks at behavioral factors and how we can better explain these products and make them easier to understand for customers. But then we came across the Home Equity Access Scheme, and that's the focus of today's topic. So it is joint work. The study is joint work with our honours student Katie Sun, last year's honours student. She won the university medal for this research in her honours year, and she's now at the RBA. And Hazel was her supervisor together with me, and we are co-authors on this project. So the motivation for this is basically for Australia, the retirement income. So there's lots of motivation for why we should look at housing wealth as a source for retirement funding. When you think about it, it's often the largest asset that a household owns. In percentage, particularly for less wealthy households, the housing wealth often makes up a larger share of their wealth. And so this was recognized as well in the Retirement Income Review, which said that using superannuation assets more effectively and accessing equity in the home can significantly boost retirement incomes without the need for additional contributions from current generation. And they also said that the pension loan scheme is an effective option for accessing equity in the home for both aged pensioners and self-funded retirees. So the pension loan scheme has been around for several decades, but it has received a lot of policy attention since 2019. So in July 2019, they opened up that scheme to all Australians of aged pension age, and they increased the amounts that you can take out to 150% of the age pension. Then last year in the budget, it was announced that the scheme will start to from this year onwards, will allow to take advances. From July this year, people can take out some amount in advance. The interest rate was lowered twice in January 2020 from 5.2% to 4.5%, and then again this January to just under 4%. There was a reprint, just a message to Australian pensioners from Santa Claus, Scott Morrison, but just before Christmas, that the scheme is now labelled Home Equity Access Scheme, getting rid of the bad loan word in pension loan scheme and lowering the interest rate substantially under the market rate for commercial reverse mortgages. So the government is trying to make the scheme more attractive and has to some degree improved the explanation of the scheme. The first time we looked at it, it was really hard to understand. It has gotten a bit better, but let me break it down for you. So it is basically a reverse mortgage provided by the government. What's the key feature of a reverse mortgage? you obtain a loan and you make no repayments. The key feature that I want you all to remember after this talk is a reverse mortgage is a loan where there's no interest or capital repayments that throughout the term of the loan is just settled at the end. That's the main difference to a normal mortgage. The end is whenever the person who lives in the home or the couple passes away or moves into a nursing home. So it's a very indefinite term to the contract. This scheme has many features of a commercial reverse mortgage. It allows individuals to stay in their home, receive an income or a lump sum, and don't have to make repayments. So it allows people to age in place, which is attractive. The interest rate is currently 3.95%, and I just looked up markets rate this morning. The lowest commercial rate is 4.75 from Heartland. It's not what's on the slide. So the government scheme is cheaper than the private schemes. So what we do, we develop a multi-period simulation study, a model to estimate the welfare gains, analyze whether it's good thing that to use the home equity access scheme for different types of Australian households. Our model accounts for financial uncertainty, house price risk, interest rate risks, and so on, and for health risk, uncertain longevity, and aged care risks. We compare welfare gains and losses, and we look at some changes, potential policy changes to the scheme. And it's a major contribution to research because most previous research is for the US. There is only one study by colleagues at Monash that looks at the home equity access scheme, but they consider the old scheme, and they don't consider aged care, which is an important component of retirement planning. So the home equity access scheme, here this chart gives you the number of participants. It's not a lot. It's just at December 21, end of quarter, they had just about 5,000 participants, very low numbers. You see that with all the changes that came through in July 19, 1st of January 20, the interest rate, and then lots of the increase is steady, but it hasn't skyrocketed. So what's the scheme eligibility? Anyone who's of pension age in Australia can access the scheme. You don't have to be an age pensioner. You can be a self-funded retiree. You can take out at the moment, it's to top up your regular income. You can take out fortnightly loans up to 1.5% the maximum fortnightly age pension. If you are a full age pensioner, that means you basically get half on top. If you're self-funded, it's 1.5% the age pension. And from July this year, you can take out lump sum advances. So you can take out twice a year a lump sum so that the lump sums and the fortnightly payments add up to a maximum of 1.5 times the maximum annual age pension rate. So there's limits on how much you can take out. From July this year, it will have a no negative equity guarantee, which will not make a big difference because the scheme already had a maximum outstanding loan balance cap, which was acting effectively like a no negative equity guarantee. And the government has committed in the current budget to improve public messaging and branding, and we are very excited to see what that will look like. So our model has the following components. We use HILDA data, National Representative Data for Australia, to classify households. We determine strategies. We have an economic scenario generator that gives us key economic variables in our model. We have a health and aged care model, and we apply an expected utility framework to assess future payments, discount them to the present values, and we compare it with industry data kindly provided by our industry partner, Pension Boost. So we model single and couple households, and we consider different types of households for with and without children, and in different wealth levels. Households receive income from superannuation, other assets, and the age pension, and they can borrow from the home equity access scheme. We consider different ways of using the scheme. Strategy 1 is using the scheme such you achieve the ASFA moderate, comfortable lifestyle standard. Strategy 2 is borrowing with that scheme to achieve a 70% replacement rate, which you will see is not so attractive for lower wealth in households, because 70% of a lower income is an even lower income. Strategy 3 is basically assessing the new lump sums that come in. So strategy 3 is taking out the maximum that is possible, going all the way up to the 150%. And then strategy 4 is taking out the lump sums that come into effect in July. We also do some tests around what changes of interest rates and what if we allow people to take out more of the scheme and see whether they are attractive. So our health and aged care model is a 7-state Markov model that was estimated for the US and is applied to Australian data. And we get a pretty good fit of our model to data from the survey of the SDEC data collected from the Australian Bureau of Statistics. So I don't have much time for these components, but I'm happy to chat more afterwards. We use an economic scenario generator developed by colleagues at CSIRO and Monash. It's an actuarial economic model calibrated to Australian market data that starts with price inflation and then cascades through wage inflation, interest rates, and then eventually gets to house prices and bond returns and so on. It's a very nice model that I want to highlight by some colleagues. So we simulate these economic scenarios and health scenarios, and that gives us basically random outcomes for individual households. We assess the financial benefits using an expected utility framework that measures happiness based as expected utility from consumption, and we also account for housing, not the value of the house, but the rent you would have to pay to get an equivalent house. We have a very innovative specification in that we have an aging in place benefit. So the longer you're in the same house, the more happy you are. We adjust for couples that they can share some consumption. We have a bit of a subsidy floor from the government, so it's a very it's a framework that evaluates very carefully the payments they can receive and the costs they have, and we convert this into a dollar amount that you would have to give them each month to make them equivalent, just equally happy as with a new strategy compared to not using the scheme at all. It's a standard economic approach to assessing retirement strategies. So in terms of, this is the main results that I want to spend a bit of time on. So the first strategy, as I mentioned, is trying to reach the comfortable, as for standard, the comfortable retirement standard. So what happens here in these graphs is I show you the benefits that these households in different wealth quintiles. So we have split our group of Australian households into, based on the nationally representative data, into 5 groups based on their wealth. One is lowest wealth, and often they also have very low income. And 5 is highest wealth, and we show you the gains that they could get from using the home equity access scheme. And first thing to notice under both strategies, the gains are all positive. And in most of these cases, for example, the red bars, most of these different types of households, for example, single women with children, they have substantial gains up to 20%. And so you would have to give them 20% more each fortnight without the scheme to make them as happy as if they can access the home equity access scheme. So we see that this using the home equity access scheme to achieve the comfortable standard of retirement gives welfare gains to many different types of households, couples and single women, both with children and without children, and in most of the income quintiles. Not so much for the higher income quintiles because they are quite well off already, and it doesn't make a huge difference to them. Still 70% replacement rate strategy is not so attractive for low income on low wealth quintiles, because it would actually, they often just fall back on the age pension, and so it doesn't give them it doesn't make such a big difference to them to use this. So they would probably prefer just to go with the age pension instead of the 70% replacement rate. So then we also look at what if they just max out the scheme, and that's plotted in blue, and it gives mostly the largest utility gains. So for basically all different household types, and they would really have much higher living standard and well-being and basically happiness in our economic model from using the maximum available under the home equity access scheme. But they also are for if people want to use the scheme to fund costs related to aged care in a nursing home or cost for receiving aged care at home, it would also give them welfare gains. So one thing that we also looked at is what happens if we change the interest rate. So I mentioned earlier that the last change in the interest rate for the home equity access scheme was lowering the interest rate. So in this experiment we evaluate what that change meant to households. So you will see that we're comparing the higher interest rate against the lower interest rate, and so there is a small difference, meaning that households are better off with the lower interest rate, as you would expect. We also looked at increasing the fortnightly maximum amount. So would it make the scheme more attractive if instead of 1.5 times the maximum age pension, these different households could take out 1.75 or 2 times the maximum age pension? And we find that this is not a very clear-cut result. So it would be attractive for many women, for different types of, so women in the second and third and fourth quintile. So most single women would benefit from this change. But for couple households, this typically means taking out more, but then reaching the cap earlier, which means the payments stop earlier into retirement, and that's not such an attractive strategy so we find that for most couple households, it's more beneficial to have not go to higher maximums, but maybe keep the current maximums or go just under 1.75 to give them a longer, higher stream of income throughout retirement before reaching the maximum outstanding loan cap, which increases by age. So we are working on this project. We had conversation on this project with a company called Pension Boost, who provide advice to retirees on how to apply for the home equity access scheme. So they are a fee-for-service provider that have advised quite a substantial share of the actual participants in that scheme. For a fee between $400 and $600, they help individuals apply for funding from basically DSS Centerlink to obtain these, and they have shared with us their database. And what we find in their data is, first of all, in more people on the full age pension apply for the scheme, as you would expect, because they tend to have lower wealth and income than part pensioners or self-funded retirees. And so that it is a scheme that attracts, say, households that are relatively less wealthy, and most people that are under advised by this main provider in this advice space take out full payments they go to the maximum. So all these blue numbers and it's probably very hard to read, but we find that 91% of those in the data set choose the maximum amount, which is consistent with our modeling in terms of what people should be doing. So this is a very stylized actuarial / microeconomic model that assesses the welfare gains for different types of households of using the home equity access scheme. And our stylized model says that there would be large welfare gains for many retiree households to improve their retirement income. So if somebody would ask me, I would say this is a good thing, that older households in Australia should use this scheme. It can make them better off based on this research. We also find that the newly introduced lump sum advances are a good method of covering unexpected health costs. And we find that most people should choose the maximums that are currently set and take out the maximum loan amounts, which are not that high because just 1.5% the maximum age pension. We analyzed interest rate reductions, and of course lower interest rates are better for households, but they have serious implications for the private market. So any kind of, we do not, in this paper, we do not suggest an interest rate. We just say it's a very careful positioning that government needs to do if they want to maintain a private market, which I think they should. We saw welfare gains of, if you want to, you could think the scheme would be more attractive if you increase the fortnightly amounts or annual caps. We only found gains for a group from, say, a large share of single female households. If you want to increase these maximums, you might also have to increase the outstanding balance cap, but then these households will hit the no negative equity guarantee faster. So it could also potentially increase the outstanding debt and the lower the amount that's available at the end. So now you probably have a lot of different questions and you say, why is she showing me this is so good and nobody is using this? So there's so many reasons for why households have a strong attachment to their home, feel very proud of having paid down their debt over their lifetime, have a debt aversion, do not understand these products, do not come across these products, don't know of these products. We just heard in Anthony's session supply side issues around annuities. There is a bit of that, I think, for reverse mortgages as well. There is often a preconception of what reverse mortgages are, which they were before they got much stronger regulation in Australia. There's also often not a full understanding of what these products actually are and what they can do. They often advertise very technical without highlighting the actual benefits to households. But I think the government scheme can play an important role in making this type of funding perhaps more attractive, more accepted, and better understood. And so we are watching this space very carefully as the Australian government has a real opportunity to be a trailblazer in this space and make Australian households perhaps more comfortable in considering this option of funding retirement. Thank you.
So thank you very much, Katja. I'd just like to remind everyone in the room and online to write your questions into Slido. And I do have a question to start. So Adrian Corbell has asked, well, there's not many participants. Does the government have a target number of participants for the scheme to be considered successful?
Yeah, so it's a good question. So we have had conversations with the Department of Social Security, who are or Social Services, who are an industry partner of our research center SEPA, and Hazel has kindly established that link. In all our conversations, no target ever came up. So I think they don't have a set target, but from the different announcement and changes, I think this is a scheme that they want to grow, but I don't think there's a target amount. I mean, at the moment, it's just 5,000 participants, and but there's 3 million homeowners over 65, so there's potential for growth for sure. Mm-hmm.
Okay, I'm going to ask you a question. We're waiting for more questions. So we know there's a private reverse mortgages are offered as well. So is there room for both a public scheme and a private scheme in this small market?
So what's interesting about the home equity access scheme is that it is you can use any type of property. It doesn't actually have to be owner occupied. So you can use investment property, farmland, farms, and land in rural areas. And I think many commercial reverse mortgages are currently offered in major cities, and maybe underserving rural areas. And so I think there's a room for smaller sized loans to be offered by the government. But interestingly, I was just looking up what providers there are, and there's a new reverse mortgage lender, Boomer Home Loans, based in Perth, and they found that the population age 55 plus is underserved financially, and so they have 4 different products, and I really like the Boomer Lite product. So it's like the home equity access scheme. So there's now a private provider that offers the exact same product as the home equity access scheme with the same interest rate, 3.95%. And they promise an easy application process. So they say, do you want small top-ups? Do you want small lump sums? Come to us and don't go to the home equity access scheme. We'll see. So I think if they can offer consumers an easy experience, easy application process, and more flexibility, private providers and larger amounts can have a role to play as well, in addition to the government program.
Okay, I've got a few questions coming up. So Stuart Mules, this is to do with commissions to advisors. So if no commission to advisor, as there's no lump sum, can the government improve incentives for advisors to recommend or have government advisors?
Yes, so that's a problem that applies also, I think, to private reverse mortgages. The company that we work with, they just have a setup fee, and I think it's a bit hard to get advisors on board. I'm not sure what the government can do. I think for the home equity access scheme, they're trying to they have a calculator, a money smart calculator. They have improved the information on their websites. I'm sure there could be always more advice. I like the initiatives of private providers who offer affordable service, like Pension Boost does. I think, I'm not sure whether that government has to, but there is opportunity for, I think, private providers to provide that kind of service.
Okay, James Marr asks, have there been any successful schemes overseas?
Yes, so the largest reverse mortgage market is in the US, where the Federal Housing Agency backs the mortgage insurance for reverse mortgages through their large lenders, Fannie Mae and Freddie Mac. So it's in the US. US has relatively the largest reverse mortgage market because it's supported by the government. So the cost of the guarantee inherent in a reverse mortgage needs to be insured by insurance, and in the US that insurance was subsidized, and now it's less subsidized but still government supported, and so that's a large market. And there's reverse mortgages in I don't know, close to 30 or more than 30 countries. I think the largest markets are US and UK and Canada, but they're all relatively small in comparison to the potential market size.
Okay. More technical questions. So Iris Lund asks, how often do the payment amounts change, if any, as interest rate and property prices change?
Yes. So the home equity access scheme has so first of all, the way the interest rate is set is intransparent for the home equity access scheme. The government decides to make announcements on changes in the interest rate. The interest rates were set the same for many, many years, and then they changed it in January 2020, and then again this year, and it's a bit out of the blue, and some market participants criticize that there should be more transparency in how the government sets the interest rate for the home equity access scheme. The payments at the moment are tagged to the age pension level, so it's 1.5% of the age pension level, and that means whatever the age pension rate of the year is, that's the maximum you can go to. But individuals have a choice of going up to that maximum or selecting a lower amount. So the loan is based on the interest rate, and the amount is based on the maximum age pension rate, and so that's relatively predictable, I would say. But that applies to the government scheme. The private market has a variable rate.
Okay, I'm going to ask a question here now. So what's the maximum amount that I can borrow? What's the maximum amount of my house that I can actually borrow under this scheme?
Yes. So I think at age, so you can take out fortnightly amounts, income streams, and basically up to 1.5% of the age pension, as I said, and then and if you take up lump sums as well, you can take up maximum 1.5 times the annual age pension rate, which is, I think, 18,000 for an individual and 26,000 for a couple, roughly, I think. And so then every payment you receive accrues a debt, and the debt is compounded fortnightly at the current rate of 3.95%, and it has caps by age. The maximum cap is 60. So the maximum outstanding debt you can have with that scheme is 67.5%. If you add that cap, your payments stop. You can no longer borrow with the scheme.
Okay. Another question. Why did you consider children as a variable in your modelling? And I would think very few people of pension age would have children under 18. Yeah.
So children are not children under 18 in our. So we distinguish different types of households, and a child is, like my mom would say, you'll always be my child, even though I'm 38 now. So a child is anyone who's a biological child, and even though they are fully grown up senior lecturer at UNSW. And that's relevant because we assume that those households who have children have a bequest motive, in the sense that whatever wealth they leave to their children gives them a bit of happiness, anticipating that they will give that bequest. So child can be an adult, and it's relevant in our utility function.
Okay. I'd say it's really quite funny, strange, taking questions from people in the room and having a silent room. Anyway, okay, I have another question from Matthew Wolfe. So do you see a large uptake diluting home ownership rates in the future?
That's a very interesting question. I have thought a lot about reverse mortgages, and one very interesting way to use reverse mortgages is to take out money against your property and give it to your kids so they can buy a property. So you know that in Australia, the bank of mum and dad is the 9th largest lender. So at the moment, Australian households use the financial wealth to give to their children so they can buy property. Now, imagine if they would borrow against their house to give that to their children. And some of the lenders advertise this. If you look at the Melbourne-based lender Household Capital, it's one of the things they advertise on their website. Do you want to support your kids, pay their school fees, help them buy an apartment? And that makes sense because you give to them when they need it, instead of when they are in their 60s or 70s. And you can enjoy this warm glow, this happiness, this giving while you're still around. And so I think if that becomes a more prevalent use of reverse mortgages, I would hope it can boost home ownership rates among younger people, but it may have implications on house prices. Every time you insert extra capital into the housing market, there's a risk prices go up.
Okay, I'm running out of questions, but I'm going to ask you another one.
Okay.
So in a session this morning, when I was just sort of surfing the web as one does, I thought I'd have a look at the yield curve because interest rates are quite low at the moment. And for example, the 10-year government bond is somewhere just under 3%. So what implications would that have for this modelling?
So so is your question around what should be the rate for the loans that the government sets? Or is
basically asking what will happen if interest rates, I guess both on private reverse mortgages or these reverse mortgages, go up quite a lot?
So because there is a cap on, so that's the more, so when you, what's really a key thing about, and that's what you learn when you do modeling like this, a key feature of the home equity access scheme is the maximum outstanding loan balance related to the property value. And as I said earlier, that starts maybe at 15% and goes up to 67.5% at age 85 when it caps out. So if the interest rate goes up and the government decides to pass on that interest rate increase in the home equity access scheme, which they may or may not do, because I would think announcing an increase to the scheme that allows our older Australians to have a better retirement will be a very difficult political announcement. So I don't see a rate increase coming anytime soon, and not of a magnitude, because it will be painful. And but if it comes, it means people's debt balance goes up faster, and they reach that cap faster, and then they just stop getting payments. But the balance will still grow at that rate. But because the reverse mortgage has a no negative equity guarantee, which ensures that at the end, when the loan is settled, you only ever the house value is used to settle the loan. There's no harm. So nobody has to, like the children don't have to give extra. So this guarantee means you can have an outstanding balance of 1.5 million, but if your house is only 700,000, only ever the sale proceeds of that house will be used. You don't have to come up with the rest. It's a loss to the lender, which in case is the Australian government. So I would say, as a younger person, if the interest rates go up a lot, I would expect my government debt going up.
For the next generation.
Yes.
The even younger generation.
Yeah.
Richard Kwan has asked a question which you've answered. It's to do with if the accumulated debt exceeds the value of the property after death of the owner, does the estate have to pay back to the government?
No, because they have this, so at the moment the scheme does not have the no negative equity guarantee, which all private reverse mortgages in Australia need to have, but from July 1st it will have this guarantee. But as I said earlier, this cap on the outstanding loan balance quite effectively has limited this, but they will introduce this in addition to ensure that no extra cash is needed from the estate.
And I'd like to thank Henry for answering the question in the chat. So, there's a question also from Henry Toe about using the reverse mortgage to help children buy a house.
Yeah.
So why not be supporting the children's cheaper home loan directly rather than pay higher interest rates through a reverse mortgage?
Yes. Look, I mean, reverse mortgages is financial intermediation, and if in a perfect world we would just sit down with our parents and make an informal contract within the family, and sometimes it is easier to transact through a financial intermediary to set up these complex financial relationships between generations. At the same time, older parents might just not have the cash sitting around that is needed for a deposit in Sydney or Melbourne. But they may have a house that they might want to tap into. So on this point, I want to mention research we did for China on reverse mortgages, where they had a government program trying to pilot this, and we decided to follow up. So we asked younger households, younger individuals who have parents who own a property, whether they would recommend reverse mortgage to their parents. And I said, I think that could be a good product for my parents. I'm just worried they wouldn't approve or they wouldn't be interested. We also asked older homeowners whether they would take up such a product, and they said that when we explained it to them in a very easy to understand way, and presented the benefits to them, they said, that looks kind of interesting, but I'm worried my children won't approve of it. And so there was totally misconceptions about each other's generations' expectations towards the use of housing wealth. So the takeaway from that research was that you should encourage an open conversation about how we're going to use this massive asset that we have. What are we going to do? And if families can work out without a reverse mortgage lender, perfect. I'm all for it. It would save a lot of transaction costs. But if it might be hard for parents to obtain a loan if they don't have any more income. So it's maybe very hard to take out a loan that requires repayments in your 60s or 70s. But if you reverse mortgage is in Australia has also become a more prevalent way of refinancing. So some reverse mortgage providers, they offer it as a way to refinance existing mortgage debt at retirement.
That's the 5-minute bell.
All right.
I think I understand. Mm-hmm. So it seems that the real challenge, there's a challenge in China and a challenge here. You have a product that you think people would like and is welfare enhancing, like many retirement products. So what can we actually do about this? Because we listen to talks about different sorts of like aged care products, annuity products, reverse mortgages. We do all the analysis and show they're welfare enhancing, but people are just not taking these up.
Yeah, so one thing that we explored with a PhD student is mental accounting. So there's a concept of mental accounting where we put financial wealth that we have in different categories mentally, and some categories are okay to spend and some aren't. And we argue in some of our research that house is in a very particular mental category. And people don't even consider it as a part of their possible retirement funding. So so what we've done with a PhD student is presenting reverse mortgages in different ways based on something that some of the reverse mortgage providers do in Australia at the moment, where they go, okay, let's talk about your retirement assets. So what do you have? You have savings, superannuation, a house, and just make it a part. It's a bit like chicken and egg. You have to almost make it overcome that potential mental accounting and get it out of that category and into, okay, that's just an asset like your other assets. At the same time, you also need to make them aware of the potential needs they have in retirement. So we found in our research that it can help in a conversation with an older household to talk to them about all their assets and actually educate them about that the house is an asset that they could consider in retirement planning, and make them aware of the wide range of potential financial needs they might have, and educate them about what reverse mortgages actually are and how they could benefit from them.
And I would just to add on to this research, this is another student of ours. So putting people in the right mental account to get them to think about housing as something I can use as income, we found it didn't get people through the door. So it didn't increase the number of people taking a reverse mortgage, but once they were through the door, it increased the amount that they would take from their house. So it's a research area that's a challenge to us, and we're chipping away at it, but it's very difficult to actually get the house in the right mental account that people think they can spend it.
I mean, it's also, there is maybe the Australian system is performing quite well in the sense that people don't need it as much yet. So I see that a bit as a question of the future. So at the moment, maybe there isn't an urgency or a need for many households to consider this, but this may change if if we just heard that 20,000 people a month retire, if we're having more and more retirees retiring with large assets and a system that may become more expensive, that may be something. So research is always a bit forward looking. So I study this because I think it will become a thing, maybe not this year or next year, but maybe in 5 or 10 years.
Okay, I'm going to do something I'm probably not supposed to do, but I'm going to hold a microphone in front of someone in the audience.
I've got a mask on, so it's COVID safe. I wondered if you had considered in your research what the impact of, I guess, deferring debt into later generations would look like. What happens when people depart this world and can't service their own mortgages, that essentially it gets passed on to the next generation, much bigger and worse. So what does that look like? Because this was a big problem in the GFC in Europe, where we had multi-generational debt and people dying, passing their debt on to the next generation.
Yes. So that was a reverse mortgage that cannot happen because it automatically, the contract finishes when the last member of the household passes away and the debt is settled, the house is sold, and the sale proceeds are used to recover the debt. And if the sale proceeds is insufficient, it's a loss to the lender. If the sale proceeds exceed the outstanding debt, then there is an extra that goes to the estate. My understanding is that in Australia, it is hard to. My understanding is that large banks have become more pushy towards retirees with more outstanding mortgage debt, sending them letters that informing them that their repayments are increasing. And so I think there's for example, this new lender, Boomer Finance, or what's it called? They advertise you can refinance with us into a reverse mortgage, and that's also what the reverse mortgage lender Household Capital offers, and some others. So reverse mortgages are a way of refinancing into a different type of loan, which finishes at death. To answer your question, I haven't analyzed this because it doesn't apply to this type of loan, but it may be applied to other loans that have this don't have such a feature.
Okay, I'm just looking at the time. I haven't heard a bell, but according to my timekeeping, we're 2 minutes over.
Okay.
So I think I will call this session to a close. I would like to thank Katja for a terrific talk. I would like to thank everyone for their questions. I'm sure some of them are in the room and I'm not sure exactly who asked them. Thank you to everyone online. Sorry we didn't get to all the questions, but some of them I thought were a bit out of order. And so I thought we'd already covered issues and didn't want to go back. So I apologise. So thank you very much. And if you've got any further questions, I'm sure Katja would be happy to answer.
Yes.
Thank you.
Thank you.